Hi, everybody who's after joining us there so far. My own name is David Looney. I work as a financial advisor with Alpha Wealth. I've been in the industry now about 10 years. Today's webinar is focused on redundancy packages and severance payments, knowing your options. It's something that has become very relevant, I suppose, in the last kind of 1 to 2 years, as a lot of major Irish employers have announced a lot of layoffs, particularly in the tech sector. And it's something we've been quite busy with in AlphaWell, particularly over the last couple of months. We did actually host another redundancy webinar earlier in the year in February, and there was massive uptake in that. And we decided just to host another one due to, I suppose, the demand that gained. I'm conscious as well as that there are a lot of employers out there that are announcing layoffs or redundancies in kind of phases as the year is going on, which is another reason maybe for us doing a second session. So look, firstly, just to say thanks very much for your time, and look, hopefully you get some benefit from it. Uh, I think whether you are, I suppose, somebody who is currently looking at severance or redundancy, or whether you are somebody who it might be on the horizon for them, I think the overarching kind of message from today's presentation is that it's really important for you to get advice and arm yourself with the information on what you're entitled to, how it's calculated, what decisions you have to make, and more importantly, how those decisions can impact your current financial situation and also your financial future. So, with that in mind, what you're going to get from today's webinar is firstly, we'll be focusing on what people are entitled to if they are looking at redundancy and how are those payments calculated. We'll be looking at the tax options and decisions around your lump sum and how it impacts your redundancy payout and also your retirement benefits. We'll be looking at some ways on how you can reduce or offset some of the tax or the potential impact of tax on taking a redundancy payment. And then there's just going to be some general financial planning and retirement planning advice throughout the webinar as well in the context of that. I am conscious that there might be a lot of people on the webinar today who might be coming across Alpha Wealth for the first time. We basically run a impartial financial services and financial planning company headquartered in Little Island in Cork. And we basically work with individuals and families like yourselves in pretty much all areas of personal finance advice. I'm happy to say this year we've celebrated our 10th year in business. And over that 10 years, we're now dealing with over 4,000 clients from all around Ireland who've close to 300 million of assets under management with us. So myself and my colleagues on screen have, a lot of years of experience, dealing with people like yourselves and helping you to manage your money more effectively. I am joined by some of my colleagues in Alpha Wealth today, including Nick Charalambis, Ruth Murray, and Clean O'Donoghue. And just to mention, if anybody does have some questions throughout the webinar, feel free to pop them into the Q&A box, and the guys will do their best to get to them. And we might just allow some time at the end as well, of course, for a bit of a Q&A session. Um, Perfect. So look, just to delve into things, redundancy packages, what does it look like? So a redundancy package is typically broken into two elements. Okay, firstly, you have something called statutory redundancy, which is kind of what you're entitled to by law. What statutory redundancy or how it is calculated is 2 weeks pay for each year of completed service in addition to 1 week's gross pay. It's important to note that the weekly pay is capped at €600 per week. So if you are somebody who's earning in excess of that, only €600 can be used in the calculations. All of statutory redundancy payments are tax exempt, they're tax free, okay? The second part of redundancy payments are what's called ex gratia payment, which is usually up to the discretion of the company. It can be an incentive-based payment, and it might also include things like, payment in lieu of notice, holidays, or maybe bonuses or something like that that are built up. Now, with ex gratia payments, part of them can be tax-free and part of them can be taxable at your marginal rate. So that depends on whether you pay tax at 20% or 40%. Now, the part of the ex gratia payment that is tax-free comes down to a set of three calculations with the I suppose the highest answer determining how much of the ex gratia payment is tax-free, and we'll be looking into those in a second. But just so it kind of resonates with people and just so it's a bit easier to follow, we're just going to look at an example here of a 30-year-old Joe Murphy. Now, the 4 to 5 key pieces of information that you'll need and we'll need when it comes to assessing your redundancy entitlements, I suppose verifying the calculations that your employer might give you, and I suppose the information that we need to make sure, I suppose, that you're taking the most appropriate decision for yourself is your current total earnings, your earnings for the past 3 years, your service with your employer, and the current value of your pension, as well as the present day value of your pension tax-free lump sum. Now, I appreciate a lot of people on the call mightn't know those last two, but they can be got quite easily through if you have an active pension in your employment. Usually the pension provider or the actuaries in that pension provider would provide that to you, and it might even feature in the documentation that your employer gives you around your severance package. But just in this example here, if we take Joe Murphy, his statutory redundancy is the €600 capped weekly pay that we referred to earlier by two by his 9 years of service, which comes out at a figure of €10,800 plus an additional 1 week's capped pay. So his total statutory redundancy is €11,400, and that's tax free. As I said, ex gratia payments can really differ depending on the company, but a common one that I come across sometimes is the employee's weekly earnings by 6 by the completed years of service. So we'll just look at that as an example. In Joe's case here, his ex gratia payment on that calculation will be coming out at about €64,368. Now, as we said already, part of that ex gratia payment is exempt from tax and part of it is taxable. And it's based on a series of 3 calculations, with the highest result equaling the tax-free element of the ex gratia payment. The 3 methods to calculate the tax-free exemption are known as the basic exemption, the increased exemption, and the standard capital superannuation benefit. It's a bit of a mouthful, but the abbreviation is SCSB. So basically, a basic exemption is €10,160 in addition to €765 for each year of completed service. Now, the reason I referred to, I suppose, pension lump sums and tax-free lump sums on your pension earlier is that with some of these exemptions, you will have an option to, I suppose, to make when it comes to, I suppose, your decision on how you want to draw down your redundancy package, as to whether you're in favor of waiving your right to the future tax-free lump sum from your pension in lieu of getting more of your redundancy tax-free now under some of these exemptions, or whether you would prefer to take a little bit less tax-free now and retain the right to take the tax-free lump sum from your pension at retirement. So for those of you who don't know, if you have an active pension scheme related to your employment, whatever the future value of that is when it comes to retiring, whether that's 60 or 65 or whatever age you decide to retire at, usually you get to access part of that future pot as a tax-free lump sum. It's typically about 25% of the fund. So if somebody has 400 grand in their pension, when it comes to retirement, they can typically access about 100 grand tax-free. With the basic exemption, it doesn't involve giving up your right to I suppose the tax-free lump sum from your pension, or waiving the right to the lump sum. Okay, so what you'll find is that some people, the basic exemption might be enough to absorb all of their redundancy payment, and they don't have to make that decision on whether they want to give up their right to the tax-free lump sum from their pension or not. But the other ones do. And the second exemption is something called an increased exemption, and it's basically the answer that comes out on the basic exemption calculation plus an additional €10,000. But just to note that that option is only accessible for those who haven't received a tax-free lump sum payment in the last 10 years and aren't currently receiving or will be receiving a lump sum from your employment pension. You can also forfeit your access to a tax-free lump sum payment on retirement if you choose the increased exemption. So if it turns out that the increased exemption gives you the highest calculation, you will have to take off the current value of your pension lump sum if you want to waive it. The final calculation is the standard capital superannuation benefit. don't get too bogged down with the calculations. Look, and I can share these slides with anyone who wishes to get them after the webinar. But how the SESB is calculated is your average earnings over the last 3 years, which is why we needed the 3-year earnings on the last slide, multiply by your years of service and divided by 15. And what you do then is you take away the current tax-free pension amount if you want to retain the right to it, and therefore basically it reduces the exemption. So I suppose if you're reducing the exemption with your pension lump sum, you're retaining the right to it. That is the pension lump sum at retirement, or else you don't subtract the current pension tax-free lump sum from the answer. Uh, Therefore, it would increase the exemption, and therefore you basically sorry, you'd forego your right to the pension lump sum. So just because I suppose, look, there's a lot in those calculations, and individual details can kind of skew the figures. It's always advised to get your redundancy payments, I suppose, just verified by a third party, on top of what your employer provides you with. So if we just take those calculations back into this Joe Murphy as an example to make it a bit more easily to follow. In his case, his basic exemption down here would be the €10,160 plus €765 multiplied by his 9 years of service, which would give us a figure of €17,045. His increased exemption would be the 17,045 above plus 10,000, giving €27,045. But if he's taken that increased exemption, as we said, he would be waiving the right to his pension lump sum at retirement. Or the SCSB calculation would be his average annual earnings for the last 3 years, which we can see here, multiplied by his 9 years of service and divided by 15, which gives an answer of 32,000. But if he's taking that 32,000 tax free, again, he's giving up his right to the pension lump sum. Or as we said, he can actually take minus the 15,000, which is the current value of his pension lump sum, away from the 32,000 to get a figure of 17,000. So basically, if Joe wants to waive his pension lump sum, the highest calculation is the SCSB calculation here. And if he doesn't want to waive his right to his pension lump sum, the highest calculation is actually the basic exemption here. So the net payout on the overall redundancy, statutory and ex gratia, including the exemptions, would be €59,584 for Joe if he's waiving his pension lump sum on retirement, or if he decides to retain his pension lump sum on retirement and take less tax free now, it will be an overall payment of 52,106. So basically, there's a difference of about 7.5 grand here in Joe's case. And I suppose the big, question that many people will face is it worth it? In this case, is it worth it for Joe giving up his right to a tax-free lump sum from his pension on retirement for an additional €7,500? Now, it really depends on the individual circumstances and their need for cash. Now, many people, it will be enticing to take more of the payment tax-free now, but they can end up shooting themselves in the foot by waiving their right to the tax-free lump sum from their pension at retirement. And remember, with compound interest, even a small enough pension now can grow to a fairly substantial pension, after 15, 20, 25, 30 years time, which gives people a lot of options at that point in time. So if we look at Joe here, we said that his pension value is €60,000, and let's just say that grew at an average annual return rate of 6% per year, which is very achievable, by the way, for the next 30 years, which would take him to age 60. That would be a future fund value of 344,000. I already mentioned that when it comes to retirement, generally you get to take 25% of that future pot as a tax-free lump sum. So at age 60, under these projections, Joe would be looking at a tax-free lump sum of €86,000. And not only would that be completely tax-free, but it gives us a lot of options. So generally people might use that tax-free lump sum to set themselves up for retirement, maybe wipe out any debt or remaining mortgage to facilitate an early retirement, maybe use it towards the purchase of a holiday home or a property, or use it to travel. So would Joe be shooting himself in the foot for the sake of an extra 7,500 now, when he's already getting 52,000 from the redundancy payment anyway? And that's why it's really important to get specific advice for your situation, because the best option for one person won't be the best option for another person, and individual details can really kind of skew the figures. Some people, there mightn't be much of a difference at all in them waiving the lump sum. It really depends on their pension value. So as I said,
David, oh, sorry, I'm going to jump in with a question that
no
we've
problem.
had. If you have already had a redundancy and waived that right for that redundancy payment, does that mean that it's for any retirement fund?
Can you just repeat that, Cleena? Sorry.
So if you have already had a redundancy and waived that right for that redundancy payment, does that mean that it's for any retirement fund? So I presume if you've waived your right to that to a previous.
Yeah, so sorry, I think I understand there. So yeah, just to be clear, if you waive your right to a pension lump sum on retirement to take more of your redundancy payment tax-free now, that only pertains to the pension linked to your current employment. So it doesn't impact any other future, I suppose, pensions from subsequent employments or previous employments. If I'm reading the question slightly different, you might need to make an allowance for the fact that if you got I suppose, a redundancy payment in the last 10 years as well, you won't be able to use the increased exemption. So hopefully that answers it.
Thanks, David.
No worries. Yes, so look, for most people, if they're looking at a fairly decent redundancy package, irrespective of which exemption they take, they will have to pay a little bit of tax maybe on their redundancy payment, or maybe a lot of tax depending on how much you're getting, obviously. But there are two ways that you can reduce the tax that you suffer on your redundancy payment, okay? The first is by making a last minute AVC, an additional voluntary contribution. Now, I'm not a big fan of the term AVC. It's additional voluntary contribution, but all it really is just a pension contribution. So if you increase your pension contribution, it's an AVC. It's just a bit of jargon for a pension contribution. But basically, if you're still working for the company, you can make a last minute pension payment, and you can do it for this year as well as last year. So, for instance, let's say we have an individual who earned 80,000 euro last year, and they paid 5,000 euro into their pension from those regular monthly contributions that are through salary. If they were in their 40s, they could have contributed 25,000 euro of their salary, which would be 20,000 euro that they could have put into a pension total for 2023. And they only put 5,000 in through regular contributions, which leaves scope for 15,000 euro. So what some employers allow you to do is actually, before you leave service, put some of your redundancy payment or your severance payment into your pension before you leave. So let's say if you maxed out for last year under this example, you'd put 15 grand into your pension, which would all go in there. It would grow tax free to your retirement, but revenue would return you 40% of that 15 grand. So they would give you 6K back in tax, which would make the net cost of putting 15 grand into your pension just 9,000 euro. It must be done before your last day, of course. If your employer won't facilitate that from your redundancy payment, if you are fortunate enough to have that money in your bank account, it might make sense to do it as well. If you don't do it before your last day and you move into another company and join their company pension scheme, you might be able to do a backdated one, or even do it to a personal pension as well. Now, sometimes when I talk to people about doing this, they get a bit turned off, because I think there's a big misconception out there that once you put money into a pension, you can't access it until 60 or 65 or 70. That's not the case. Most pensions can be accessed from age 50 onwards, okay? And that includes all company pensions. They can all be accessed from as early as 50 onwards. So for a lot of people that are in their maybe 30s or 40s, it's not tying away the money for a very long period of time. And as you can see, there's a massive tax advantage of doing so. The other is by reinvesting the after-tax redundancy monies or some of it into a scheme known as the Employment Incentive Investment Scheme. It's basically a government-backed investment scheme which allows Irish taxpayers to invest money with qualifying small to medium-sized Irish companies over a 4 to 5 year period. And the government back it for companies as it basically kind of allows companies to raise capital to basically, I suppose, promote employment and economic growth, etc. But the reason you would do that is that if you identified a company that you were happy to invest with, revenue would actually give you a tax rebate on your investment amount, which can range from 20 to 50%, but the typical is about 35%. So let's just say we got a redundancy payment, suffered some tax on it, and then decided to put 10 grand of the after tax redundancy monies into an EIS scheme, which typically is 4 to 5 years in duration. In year one, revenue would actually return us €3,500. So that's 35% coming back to us on our investment of 10,000. And then in the final year of the scheme, which is usually 4 to 5, year 4 to 5, as I said, you would get your initial €10,000 back from the company plus a return or interest from their side. A typical interest rate will be about 30% over that full duration. So potentially you could be getting €13,000 back in 5 years' time. So if you look at that, you made a 10 grand investment, revenue gave you back 3.5 grand. So the net cost of your investment was only €6,500, and then potentially you're getting €13,000 back in 5 years' time, which is a double your money scheme. It's the only scheme or option, let's say, that exists in Ireland outside of a pension scheme to get tax back at a very high level. As I said, it's called the Employment Investment Incentive Scheme, but it does, of course, involve some risk. So what we do in Alpha Wealth is every year we look around at some of the types of companies that are raising EIS capital, and we'll generally cherry pick maybe the top 2 to 3 companies every year as a viable option for our clients under the scheme, who are looking for ways to reduce their tax bill. One of the strongest options we've identified this year so far, just to give people an example of some of the types of companies that are raising capital, is a company called 5 Mile Concepts, who are in the hospitality and coffee sector. Now, firstly, even though 5 Mile is a relatively new venture, it is run by the operators or the same people involved in Clish, the hospitality group, who are one of the largest hospitality companies in the Irish market. They own and operate about 20 hotels, bars, and restaurants across the country, which include a lot of the Radisson hotels, the Muckers Park in Killarney, the 5-star, and the Hibernian in Kilkenny, as well as some other bars and restaurants up and down the country. But basically, last year they acquired a site just outside of Middleton in County Cork, which is in a fantastic location. It's on the main national road, which links kind of Cork and Middleton to East Cork and Waterford and stuff. And it's just in front of a new Greenway cycle track that's planned. But they're basically, after demolishing the initial structure and putting down fairly, I suppose, extensive renovations. And there's basically going to be a couple of different income streams in this new venture. Firstly, there'll be a cafe, there'll be a bar and restaurant, which is, targeting anything from the brunch market right up to evening trade and everything in between. But also there's a coffee roastery gone in there who are, the bar, restaurant and cafe are trading under the name The Fork and Wheel. That's due to be opened this November. But there's also a coffee roastery going in there, and they're currently making their own coffee on site. And the coffee is trading under 5 Mile Coffee, and those beans are currently being distributed through the Clishta Hospitality network of hotels, bars, and restaurants, as well as rolling it into independent cafes across the country, which they're already in negotiations. So I suppose what you have here is a company that's been, I suppose, managed by a whole host of hospitality veterans who have a lot of expertise and experience, and obviously you have the economies of scale there that the overall group brings, as well as a venture that has multiple income streams, from the cafe to the bar to the restaurant to the coffee roastery. So if anybody is interested in hearing a bit more about that, look, we're happy to link in with people after the webinar and discuss it with you.
David, I'm just going to jump in there with
Yeah.
another question just before you move on. In terms of AVCs, does every company allow you to top up AVCs from the redundancy fund?
No, not every company does. As I said, if you don't get your payment until after leaving service, you would basically have to finance the AVC from monies in your bank account. So, for instance, let's say if I had 10 grand in my bank account that I didn't need or that I knew was going to be reimbursed by redundancy monies coming into my account anyway, I could write a check for 10 grand or transfer 10 grand to my pension provider that's linked to my company. The pension provider would allocate the full 10 grand into my pension, which would grow tax free to my retirement. They'd usually give me a certificate for that contribution, and I could immediately go online then and do amend a tax return or do a tax return for 2023, and revenue would give me 4 grand back. So they're basically returning me €4,000 income tax that I would have otherwise suffered on that money last year, which then therefore reduces the overall tax hit on the redundancy payment when it does land in your account after you leave. The other thing you can do is just wait until you have access to a new pension scheme, or just make a contribution into a personal pension after you leave service and after you get your redundancy payment. But to answer the question, not every employer allows you to directly put the redundancy payment in there, but you do have options outside of that anyway.
This person has just come back and said, but if I did it before my last day, so I presume, I don't know what their kind of, is it that they've been made
So
redundant already and have they made the payment, or are they wondering, can they make the payment maybe?
yeah, so
Um,
just to avoid confusion, okay, everybody can make an ABC payment before their last day. What I'm
okay,
referring to is if the company will allow you to put some of your actual severance payment
okay.
into your pension before leaving service. Not every company will allow you to do that, because they might give you the payment, say, after your official leaving date, because once you're effectively no longer employed by the company, you can't make pension contributions to that scheme, but you can make an ABC contribution from maybe other funds that you might have in your bank account.
So that's why maybe
Yeah.
looking at something like the EIIS scheme or something like that might be another option if you
Yeah,
can't make.
exactly. EIS, or you can do just like a once-off personal pension contribution as well. So, like if I was made redundant this week and 2 weeks' time, I could always just say set up a personal pension with Alpha Wealth or another broker, put whatever 5 grand, 10 grand into that as just a once-off contribution, and then claim the tax back from revenue.
And I presume you'll be addressing the whole thing on pensions and, what happens to my pension if I get another job? Should I transfer it over or should I leave it where, or what should I
Yeah,
do with
yeah,
that
no, it's
pension?
it's
You'll
it's
probably be
actually
addressing that.
yeah, exactly. It's actually that's what I was going to talk about next. So,
Perfect.
obviously the webinar was focused around redundancy and severance payments and your decisions and options there, but there is another really important decision that you have. And it's something that, a lot of people don't put much focus on, but they should, because there's a massive opportunity around your company pension once you leave service. So generally, a couple of weeks after leaving service, you will get something out in the post or by email called a pension leaving service options form. And it'll usually have 3 to 4 options on it as to what do you want to do with your pension. So the first option is to leave it where it is in the scheme, and you get to access that under the normal retirement age in your employer scheme, which is typically somewhere between 60 and 65. Most are 65. You can transfer it into your new employer scheme as option two. So if you go to work for another company that has a company pension scheme, you can amalgamate it all under the one. Number three is you can transfer it to a pension bond, which would be like a personal retirement bond or a buyout bond. They're all the same thing, or something called a PRSA, a personal retirement savings account. And you can access those from age 50 onwards. So that generally tends to be the most popular option for most people. Or if you were somebody who was in your pension scheme for less than 2 years, you actually might have an option to take a refund of your contributions minus 20% tax. But if that's available to you, you generally lose the company's contribution. So you're only taking a refund of your own. Now, this can actually be quite advantageous if you think about it for those who are top rate taxpayers. So you can be quite clever. Let's say I joined a new job, I'm a top rate income taxpayer. Therefore, I'm getting 40% relief on my pension contributions, and I know I'm going to be laid off or lose my job in the next 6 months. I could go hell for leather on my pension contributions over the next 6 months, get 40% relief on all of the money going in there. And then as soon as I leave the company, I could take it all back out, only minus 20% tax. So you're guaranteeing a 20% uplift there for those who would be in the scheme for less than 2 years. But for anyone who's beyond 2 years in the scheme, it's the first three options here. Now, I'm not a big fan of people leaving pensions behind in old company pension schemes. Why? Because look, there's a lack of control, there's a lack of management and transparency. Do you really want to be trying to track down your old employer at 60 when you want access to pension and get them to sign off on it? Probably not. It's also restrictive because you're stuck in the old scheme fund options and provider where there's loads of other options out there. And a lot of people go to transfer their pensions into their new employer scheme as well, but that you can be shooting yourself in the foot there as well, because what you're doing there is tying up all of your pension pot into one scheme, and you can't access that until you either leave or retire from your current company. So you lose a lot of options, which is why three is the most favorable one for a lot of people, because not only does it allow you to keep those funds separate, but it allows you to transfer it into something in your own name with any provider or any fund that you want. And you can access those monies from age 50 onwards. Whereas with company pension schemes, whether it's your old company or your new company, you probably can't get your hands on it until age 60 at the earliest. So it kind of ticks the box for a lot of people. Generally, the most important things you need to focus on when it comes to your pension is where is the money invested, or what funds are you in and how are they performing, but also when can you access it and how easy it is to access it. And just to note, like, a lot of people think that the strength of the old employer needs to be taken into consideration with pensions or defined contribution pensions, which most of us have. It doesn't at all. Your pension is tied to the funds that you're invested in. So if you're invested in some Irish Life fund, which is, not performing that well, your strength of your old employer, or whether that's Apple or Striker or whatever, has absolutely nothing got to do with it. So the number one thing is to make sure that the fund that you were invested in is, best in class. And in my experience, a lot of company pension schemes are not in the best funds. So Alpha Wealth operates as I suppose, an independent provider of pensions. We deal with every main pension provider in the Irish market, so we've no vested bias in choosing or recommending one provider over another. So what I'm doing here, just to show you the massive difference that's out there in terms of the returns from various funds and various fund managers in the Irish market, is that I've ranked some different funds from different providers. All of these funds would be a similar risk class of funds, so they'd be a risk level 5 on a scale of 1 to 7. That's a moderate to high risk fund. The reason I've chosen that is because it's probably the most popular pension fund. It would suit anyone from their kind of 30s into their 50s, to be honest. But you have a couple of different providers here. You've Zurich, you've Irish Life, who actually have a massive share of the corporate pension business in Ireland, but their funds haven't done very well. And I'm actually after comparing two different Irish Life funds that are both risk level 5, and you can even see that there's a huge difference between a similar fund in the same provider. Mercer, a lot of people on the call today might have pensions with as well, and Aviva is another big provider in Ireland. But Zurich's main Prisma 5 fund here, which would be their main moderate to high risk fund, over the last 5 years, that's delivered a return of 69%. Or since the fund was launched, you can see its annualized returns are close to about 10% per year. The same risk level Irish Life fund is less than half of that. That's a massive difference in terms of, I suppose, growth or potential growth on your pension. As we already said, there's even a difference between the two Irish Life funds here, the consensus fund. So it's really important to get your pensions reviewed by an independent advisor to firstly make sure that you're availing of the best options within your current scheme, but also exploring if there's an option to maybe move any previous pensions out to better performing funds, because even a
So
small
David, on that,
difference.
can I
Yeah.
jump in and just ask you, like, what does that entail? So let's say I'm working with a company, the provider of the pension is Irish Life, I'm being made redundant, and I want to move my pension, which looks like to Zurich. What's involved in that process?
Yeah, so basically what we would be doing there, Clean, is we would be moving the pension funds into a personal retirement bond or a PRSA, which is just a different type of pension product. It works like any other pension, continues to grow tax-free. Options at retirement, they're the same. The only difference is you get to access it from 50 onwards, but we can choose any provider or any fund in the Irish market for those for that new pension, and naturally we'd be trying to identify the best performing funds. So it's just a case of ticking that you want to move to a personal retirement bond in your leaving service options form, engaging with us. We'll set up the new personal retirement bond. We'll send the leaving service options form away to the old provider, and we'd manage the transfer between both providers. So the old pension provider would send the monies across to, let's say, Zurich. They'd invested in your new pension, they'd activate it, and away you go. You have a new pension in Zurich in
And
what?
on
Yeah.
that, so you're saying that if I left it in the old company and let's say left it in Irish Life, I couldn't access the pension at the age of 50.
Yes, generally
Okay.
most company pension schemes have a normal retirement age of 65.
Okay. So that's a huge benefit. Okay.
Yeah, exactly. Yeah, because like what we're getting now, I suppose there's a lot of people are doing this kind of phased retirement where maybe at, let's say, 55 or 58, they're maybe going back to 2, 3 days a week. And if you have your pension separate, let's say it's in a personal retirement bond, you could actually draw on the personal retirement bond at, let's say, 55 to maybe supplement the reduction in income for you going back to part-time. And then maybe at 60 or 65 or whatever, you can draw on your main scheme. Whereas if you're somebody who amalgamates all of your pensions constantly and they're all tied up in your main company pension scheme, if you want to go back to 2, 3 days a week, you can't access any pension because you haven't retired basically from your current employment. So just be careful about amalgamating pensions. But performance is the number one thing for me. Like just to show you how I suppose impactful it can be, let's say you 50 grand in a pension growing at a 4% per year interest rate for the next 30 years. That would be a future fund value of 162 grand. However, if you have the same 50,000 euro growing at just 2% per year more, and as you can see that difference does occur, like even the Irish Life consensus there, it's only done 5% per year since launch versus Zurich's, nearly 10%. But even a 2% per year difference, the future fund value would be 287,000 after 30 years versus 162,000. So you could literally be costing yourself hundreds of thousands of euro by not ensuring that your pension monies are invested in the best place. And the only way you're going to ensure you're in the best place is by dealing with an impartial provider who has access to all of the providers in the market. So outside of pensions and redundancy payments, if you are exiting your employment, it's important to consider any other benefits that you might lose on exiting your company. So things like, debt and service, which is life cover. Generally, a lot of large companies would have a debt and service policy that might pay, say, 2 times or 3 times or 4 times a payment of salary to the dependents if somebody died in service. Then you have an income protection or income continuance or permanent total disability. They're all the same, or health insurance as well. So you need to ask yourself the question, is there a need for you to affect personal policies to protect you and your family now that you no longer have these company benefits? And we can, of course, give advice on that, as well as advice on any shares that you might hold in your company. I'm not a big fan of people holding a lot of money in, I suppose, company shares. I spoke to a client yesterday who worked with Pfizer's for 20 years and he's loads of money in Pfizer shares. And not only is that crazy from a risk perspective because it's all eggs in the one basket, there's thousands of company shares that you could be invested in. So why would you have it all in one place? You're really exposing yourself. But Pfizer share price has done brutal over the last couple of years. So, you can both reduce your risk and exposure and get better returns by maybe selling some of your shares and going into more diversified portfolios. And of course, we can help with that. Um, what I just want to talk about finally is getting your redundancy money to work, because if you are somebody who's looking at a big payout and maybe you're moving back into another job straight away or in the short term, we never want a scenario really where we have large amounts of unused money just sitting in bank accounts or credit union accounts as years go by, because the one challenge we all face is inflation. typically inflation is about maybe 2.5% to 3% per year. So everything gets more expensive by about 2.5% to 3% per year. On average, it was more last year. It's a lot less this year, but we're talking about average. So if your money is earning a return of about 3% per year, you're actually losing value or you're going backwards. So the only way that we can ensure our money is being kept pace with inflation or ideally outperforming it is by investing it. And there's brilliant both monthly and lump sum investment lump sum investment options out there, which can get you um, proven returns of about 5 to 10% per year. They're accessible and flexible, and they allow you to benefit from compound interest, which is this kind of snowballing effect over time, like we saw with some of the pension projections that we looked at earlier. And the key thing about, I suppose, investing or risk is that it can be controlled. There's loads of different, I suppose, risk level options out there. You can go from low risk right up to high risk and everything in between. Moving your money out of a bank account or a credit union account doesn't mean you're automatically going from, a risk level 1 up to a risk level 7. We basically launched a couple of years ago something called the Alpha Savings and Investment Club, which was intended to educate Irish savers on some of the alternative savings options in the Irish market. And basically, what we do is we provide access to some of the best savings funds in the Irish market for both monthly contributions, which can be started from as little as €100 per month, as well as lump sum contributions. And basically, the plan is very flexible. You can pay into it regularly. You can increase, decrease, stop, and restart as you wish. You're not tied into anything, so you can pull the money out at any stage at no penalties. As I said, you have access to a wide range of saving funds at different risk and reward levels, which all have exceptional long-term track records. So plans like this are ideal for any kind of medium to long-term savings goals, like saving money for kids' education or college fees. We give the investment advice, and we also set up these plans at some of the lowest costs in the Irish market. We even give people an extra 1% on their savings to cover the government levy of the 1% government levy on these plans, to make sure all of your money is invested from day one. Just to give people an example of one of the funds that we typically use, one of them is the Zurich Balance Fund, which is one of the oldest funds in the Irish market. It was launched in 1989, so it has a more than a 35-year track record. It's managed by Zurich, who are not only one of the largest insurance and investment providers operating in the Irish market, but they're one of the largest worldwide. So you're getting a lot of experience and security and convenience there. The balance fund in itself, as you can see here, provides exposure to over 600 assets. So it's extremely well diversified. So going back to that example earlier about somebody having all of their money in Pfizer shares that have been losing money for the last couple of years, why would it not make sense for you to sell some of those shares, move it into this fund where you move your exposure from one company to over 600 companies and get better performance? And as you can see here, the average returns have, been in and around kind of 10% per year. And so you have a fund here which, has a very long-term track record. You can see is very well diversified and has produced, very, very decent returns. Over the last 5 years, the fund has returned about 54%, and that's even taken into consideration the challenges that we've had, like, COVID, rising interest rates, war, etc. So just to wrap up the presentation, and we'll open it up to a Q&A session, but I suppose we do offer everyone the opportunity to book in for I suppose, a financial planning consultation with us, where we will not only look at and give you advice on your redundancy and pension options, but basically take a holistic approach to your, I suppose, financial aspirations and your financial situation, and give you tailored advice to get you into the best possible financial position and plan ahead. That might include, helping people to build up money to buy a property, or save for their kids' education down the line, or reduce their tax, or get them into a position where they want to retire early. And we do all of that throughout that consultation process. Our normal consultation fee is €199, but we have decided to reduce that fee to just €99 for those who are either facing redundancy or possibly facing the prospect of it on the horizon. So if anybody wants to link in for a one-to-one consultation following today's webinar, you can contact me by emailing dlooney@alphawealth.ie. As I said, we will be sending out this recording and the slides for anybody who wants it. But otherwise, look, thank you very much for your time. I hope you got some benefit from it. And as I said, look, we can open it up to a bit of a Q&A session there if anybody has questions.